Hello, judges and fellow debaters. The motion is that keeping a residential investment property outside super while investing the student managed fund in a low-cost, high-growth, diversified index will, in most realistic scenario, deliver higher terminal yield and lower sequence of return risks. As the first affirmative speaker, my job is to lay the foundation. And the point is simple. When we judge retirement strategies by after-tax yield, compounding power, and risk, the index strategies inside super is clearly superior to property. Let's start with the numbers. Over the last 30 years, the ASX 200 has returned about 9.3% per year with dividends. Australian housing has done closer to 6 or 7%. Some argue property looks better because of leverage, but James O'Reilly's AFR study in 2025 gave property average advantage, 5.4% growth, 3.4% rental yield, 80% debt. Even then, after 15 years, the diversified index still finished over $1 million ahead. That is why he calls it the $1 million mistake. The second reason is compounding. If you want to own a house, keep it outside super where you can live in it or refinance it. Inside the fund, let compounding work at full strength with a low-cost index. The S&P 500, for example, has averaged over 10% a year for 50 years. $100,000 at that rate becomes nearly 1.9 million in 30 years. A self-managed fund with properties never gets closed because fees, audits, and 5 to 7% transaction costs keep dragging it down. And third, liquidity. Index funds are liquid. You can sell a small parcel any day to meet pension withdrawals. A $1 million house is not liquid. You can't sell a bedroom when you need cash. Funds with property often hold big cash buffer with dilute returns, or worse, they are forced into buy or sell in downturns with 4 to 5% stamp duty, 2% agent fees, and maintenance on top. One sale can wipe out $10,000 of dollars. That's exactly why property in self-management fund is illiquid and risky. So to sum up, equities in a diversified index deliver more yield, keeping property outside preserves flexibility and liquidity protects retirees from time risks. On those grounds, the affirmative case is clear. We now invite the first speaker from the negative team to present their arguments and show us why they believe property inside superannuation could still compete. Thank you.
Good morning. So thank you for the affirmative frame. However, Arakan is a little bit too narrow. So let's figure out together why I'm going to say that this approach can be a tax efficient, stable, and strategically valuable choice. It ignores the potential tax advantage of holding property inside a superannuation fund, especially once the fund enters the pension phase where income and capital gains may be taxed at zero, as I will show you in the next slide. Here's the two phases that I have mentioned of the tax scenarios: accumulation phase and pension phase. Thus, if the property is held for decades, those tax savings accumulate into a meaningful difference in terminal wealth compared to holding the property outside the fund. When we come back to our chart, for the high income contributors, placing property inside a superannuation fund can reduce the total tax. In the accumulation phase, rental income is taxed at only 15%, as you can see in the second column. However, it can fall to zero in the pension phase. The affirmative view also overlooks the scenarios where residential property delivers stable net rental cash flow that supports the fund without undermining compounding. For instance, the 1 million worth property with a 3% per annum net yield, which will result in $30,000 of annual income and low debt impact result from the minimal deduction. Additionally, if the property is carefully chosen with low leverage and strong tenants, it can be net cash flow positive And over a long horizon, that stability offset transaction frictions and avoid forced selling. Unlike equities, which can have high short-term volatility, rental income is steady and can have fund superannuation expense directly. Lastly, there are also non-financial consideration. Holding property inside the superannuation system provide legal protection and centralized governance, which will support the educational objectives like valuation skills, due diligence, and risk management. So to sum up, rather than being a mistake, suggest holding property inside a fund, which can, under the right condition, be a tax efficient, stable, and valuable choice. Next, To will go for the next affirmative frame.
Thank you, King. To keep us on track, I will address three issues from the other side: tax friction and governance, and then set our case. First, tax concession attached to the superannuation wrapper, not to the assets in the complying self-managed superannuation fund. Earnings are taxed at 15%. Capital gain on assets held at least 12 months receive a one-third discount, and retirement phase income is treated as a same current pension income. Those concessions apply equally to a broad listed index and to direct property. If the tax rules are the same inside the wrapper, the difference must come from everything around the assets. As for friction, property brings transfer duty on day one, legal and inspection costs, council rates, insurance, maintenance, valuation, audits, property management fee, and a standing cash buffer to meet pension and payment. A broad exchange-traded index fund typically charges single-digit basic point fees and does not require that buffer. So in practice, the headline tax benefit is also bounded by contribution limit, division 393 for high-income members, and that the transfer balance gap. That context, here's why our structure win on outcome. Firstly, is cost compound. Terminal wealth equals starting wealth multiplied by the product of each year one plus net return, which is net of fees, taxes, cash buffer, crack, and transaction friction. Property inside the fund makes every subtraction larger: upfront duty, ongoing maintenance and compliance, valuation and audit effort, agency fees, and the buffer. A low-cost diversified index keeps those cracks tiny, so the compounding curve is steeper. Under our assumption, start at 100. At 7% for 15 years, you finish near 276, and at 6%, just 1 point lower from friction, you finish near 240, and about 36 gap on every 100 is per friction. The index keep that to 30 plus working for members. And next is about the sequence, risk and liquidity. Two parts can share from the same average return, yet if the bad years land early while the fund must pay pension, outcome diverge with a large illiquid trailing. Early losses plus required withdrawal can force a big sale at the wrong time, permanently shrinking the base that can recover. And with a liquid index, the fund sells small slices, rebalances, and avoid crystallizing one oversized loss. And using the same average return, our bad early path ends around 212, while the bad late path ends around 245. Liquidity is risk control, not convenience. The ATO also expects that investment strategy to address liquidity and diversification, a single trailing structure to satisfy both. And the last point is duty of care. Fiduciary duty favors transparency and auditability. Prices and statements are observable daily. Rules-based rebalancing enabled by liquid low-cost unit and cost leadership. Every basic point saved compounds into dollars, and high liquidity to avoid forced value destroying sales, and a single leverage how concentrate risk and fails to those tests. broad low-cost index meet them cleanly. So both together equal tax rule, lower friction, superior liquidity, and better governance. In most realistic scenario, keeping the residential investment property outside the superannuation and investment the student managed fund in a low-cost, high-growth diversified index deliver stronger compounding, lower sequence of return risk, and better fiduciary practice. That's why our structure produce higher terminal wealth. So negative speaker to Lynn, the floor is yours.
Thanks for your perspective too. Now I'm gonna explain my idea about this problem. So your team agreed that investing in residential property within a superannuation fund will incur excessive costs like 4 to 5% of stamp duty or agent commission and so on. But they are not fixed. These costs are not fixed. They are negotiable and they largely depend on the trustee management strategy. So as doctors Raftery observed, standard agent commission are average about like 7.7%, but it can be negotiated down to 6.6%. So you can see that trustee can minimize maintenance costs by selecting cost-effective, efficient service provider or managing their property internally. So the upfront costs like stamp duty and legal fee may appear significant. They are one of expenses like when you hold a property for more than 10 to 15 years, this cost will become small compared to the capital growth and rental income. Like, for instance, a 5% stamp duty on 800,000 property will equal to only 0.33% per year over the 15 year, far below the average annual property appreciation rate. So with the concession 50% tax environmental of a super fund, such costs have minimal long-term impact on the overall performance. So holding a property does not shift to compounding, as majority of the portfolio can remain invested in low-cost diversified indicate. Like Dr. Raftery note, early modeling from O'Reilly 2025 AFR study assumed an unrealistic 80 to 20 gearing ratio. This will result in higher risk and interest costs. Like a more balanced 50-50% structure would be better reflect SMSF investment behavior. So finally, a Raftery regression analysis on SMSF costs found that expenses depend on many element like fund size, number of member, and risk profile. So larger and simpler fund, such as those with single property on or term deposits, tend to operate for and more cost effectively than those with multiple assets and frequent transactions. This suggests that in practice, property with an SMSF can remain both efficient and sustainable when appropriately scaled and managed.
So let's return to the core frame. After fee, after tax terminal wealth, sequence of returns risk and liquidity. The negative team says costs can be negotiated and already assumptions are too harsh. But even if we adjust those numbers, the structures stay the same. Property inside Super still faces high fixed expenses, limited liquidity, and uneven cash flow. ATO data shows average SMSF running costs around $8,900 a year, while buying and selling property typically at 5 to 7% in transaction costs, expenses that no investor can truly avoid. In contrast, low-cost index funds charge around 0.1% per year, maintain full liquidity, and have delivered 9.3% annualized returns over 30 years, far higher than housing's 5 to 7%. This means after all fees and taxes, the diversified index still compounds to greater terminal wealth with far lower sequence of return risks. So on efficiency, liquidity, and risk, the evidence favors separation. Keep property outside super and let the fund compound inside through a diversified index. Thank you for your attention. And here's our references.